Okay, in this lecture, I'm going to talk a little bit about credit scores, credit cards, and student loans. Now, most of the basic material and information that you need about these topics is covered pretty well by the readings. It's very important that you read these sections of the readings before you watch this video. Otherwise, a lot of this is probably not going to make a lot of sense to you. But there are a few things I want to talk about when we talk about credit scores, credit cards, and student loans. Now, when we're talking about a credit score, we're talking primarily about your FICO score. There are other credit scores that are calculated in different ways. However, the FICO score is the one that is most commonly used by lenders, by landlords, and by employers to check your creditworthiness. Because if you were to lend money to somebody, wouldn't you want to know something about them? Right? Wouldn't you want to know, is this person reliable? Is this the type of person who will pay me back? You can check if they have money to pay you back, but it's harder to check that they're the type of person who can pay their bills on time and is likely to use the money they have to actually pay you back. And that's what credit scores try to do. Now, FICO, we don't know exactly what goes into this score. Okay? FICO's calculations, its formula, is its main product. It's like the secret recipe for Coca-Cola. Okay? They guard this recipe. They do tell us a little bit about what's in there, right? Just know how we know that Coca-Cola has water and sugar and right, you can read the ingredients list, but that's not enough information for you to actually be able to create Coca-Cola for yourself at home. Likewise, we know about what's in your FICO score, but that doesn't give us enough information to actually reproduce the FICO score completely. But as you can see from this chart, most of what determines your credit score is your payment history and the amount that you owe. If you just pay your bills on time and don't borrow too much, don't use all of your credit limits on your credit cards, and don't borrow a ton of money on your house, like if you just don't overdo it and pay on time, you'll have an excellent credit score. If the length of your credit history, new types of credit, and types of credit that you use are helpful, but they really seem to be the cherry on top. You can get an excellent credit score with a very short history, very few new credit, and almost no variety in types of credit. So if you're worried about getting a good credit score, just pay your bills on time and don't max out your credit cards, and that will take you a long way towards having a good FICO score. Manipulating the credit history, the types of credit, right, working those is helpful. It can improve your score, but that's kind of sophisticated and beyond the scope of what we're looking for this class. If you want to really maximizing every little bell and whistle in the FICO formula, then you really need to consult an expert because it gets complicated very quickly. But for our purposes, just paying on time and not maxing out your cards, keeping the amount that you borrow below 50% of your limit, that will take care of you. That'll get you 90% of the way back. Now, let's talk about credit cards a little bit. Credit cards are extremely useful. Okay, they're very convenient for paying, they're good for building your credit history and thereby your credit score. There are certain things you can only do with a credit card. For example, you need a credit card to book a hotel room or book a flight. And these things can only be done with a credit card. They also provide increased security over a debit card. If someone uses your credit card fraudulently, it's much easier to battle than it is a debit card. So they're also more secure than debit cards. There are a couple problems with them. Research has shown that people are willing to pay twice as much for things when they use a credit card than when they pay with cash. Now, I know what you're thinking. Like, hold on. I'm not willing to pay $4 for a gallon of milk with a credit card if I could get it for $2 with cash. I'm not going to do that. I'm just going to pay cash with a credit card. That's not what this statistic means. Let me tell you where this number comes from. The first time they found this result was they went to Harvard, and they had a bunch of students come into a classroom, and they had a table full of just Harvard swag, mugs and mouse pads and t-shirts, and then they gave the first group a bunch of cash. And they said, okay, you can buy anything on this table. Anything you buy with the money we just gave you, you can take with you for real. It's not theoretical in any way. You just tell us what you're willing to pay for it. And so they had people bid on the various items, trying to be the one who got to take it home. They recorded how much people paid for each item. And then the class took the money, gave them their items, and excused them. Then they brought in another group of people. This group of people, they gave them a card and told them that the balance on that card was the same as the amount of cash the last group had got. So they had the same amount of money, both groups. And then they gave them the same scenario. Okay, You can buy these things with the money on your card. How much are you willing to pay? And they found that the first group, the most anyone in that group was willing to pay for a mug was $2.50. That's what the auction came to. But the group with the credit cards, they were willing to pay $5 for that. They competed and bid the price up to $5. And this double, right, this 100% increase in willingness to pay comes, we believe, from the way our brains are wired. When you swipe a credit card, you're not actually losing anything, right? Your elephant, your back brain, doesn't recognize that you've lost something. So there's not like an emotional pain, right? There's not an emotional response to that, not a strong one anyway. Versus if you open up your wallet and you pull out cash and it disappears and it goes away, that's much more tangible, much easier for your elephant to say, hold on, I've lost something. You can watch your pile of cash dwindle, dwindle, and dwindle. And that causes a nervous response, and that makes you less likely to pay for things if you're using cash. So you have to be careful with it. It's easy to lose track of how much you spent on your credit card, too. And if you're not being proactive and checking your balance and keeping up on it, it slips away from you, and then you get to the end of the month, and you get your credit card statement, and you're like, holy cow, how did I spend so much? Versus if you just had a stack of cash in your wallet, you would know how much you'd spent as you went. It automatically tracks itself. And so if you're going to use your credit card, you need to be careful and you need to watch yourself and keep track every week. Log in. How much have I spent? How much have I spent? So that you don't lose track and you don't get surprised. You don't wind up spending more than you would have otherwise if you were keeping track consistently. Now, how should you choose a credit card? Well, there's a few relevant factors. Okay? First is the APR. This is the interest rate. So the higher the APR, the higher the interest rate, the more using the credit card will cost you, right? The more interest you'll have to pay when you carry a balance. However, it's actually probably not quite the most important thing to worry about. The grace period is extremely important and arguably more important depending on how you use your card. The grace period is the period of time between when you make a purchase on the card and when interest starts being charged. Now, most credit cards have a 30-day grace period. And what that means is if you pay the balance off every single month, pay it down all the way to zero every month, you will never be charged interest. I've been using a credit card for over 15 years, almost every day, and I've never paid a single penny in interest. Okay, this is what's called convenience use of a credit card. If you're a convenience user, you just use it to make your transactions and then pay it off every single month. Versus a revolving user who carries a balance. And when you're carrying a balance across months, then that interest rate becomes extremely important because it determines how much interest that you pay. Now be careful with grace period. A lot of times people assume a credit card always has a grace period, and that is not true. Some credit cards have no grace period at all. They start charging you the second you swipe. Those credit cards you should avoid, right? You want that grace period to give yourself a chance to pay it off so you don't have to pay any interest. Be sure to check. Most credit cards do have a grace period, and most of the time it's 30 days, but there are exceptions, so read carefully before you sign. Look for a no-fee card. There's usually not really any reason to pay a fee. Now, some cards offer better rewards, but they have a higher fee. And so a lot of people think, well, I'll pay the fee, but it'll be worth it because I'll get more rewards. That can happen, but be careful. Remember, who created this rewards program? The credit card company did. What's the credit card company's objective? To make money. And where do they make their money from? Your wallet. So, would they offer this program if the cost to them, the rewards that you earn, is greater than the fees that they earn? The answer is no. If you think you might be the exception, like, well, my spending is such a way that I'm going to get more benefit than the fee costs me, that can happen. That can be real. For example, I had an airline credit card for a long time. I was flying a lot. And the airline I flew had where if you earned a certain number of points, they would give you a companion pass. And so every year I'd get that companion pass because I was earning so many reward points from so many flights that all year long my wife got to fly free anytime I went. Now that card had a $150 fee every year. but I saved at least $2,000 a year on airfare with that companion pass. So I benefited tremendously from that credit card, and the fee was well worth it. And that could happen for you too. If you think you're that person though, just be careful because you're the exception. So you better be sure, be very sure that you are the exception before you decide that it's worth it. Odds are that you aren't. That one airline credit card is the only time I paid an annual fee for a credit card. I don't have that card anymore. And I don't have any cards now that have any fee because I don't fly as much anymore. And so there's no card out there that I have found where the fee is less than the increased benefit that I would get. And so for a few years there, yes, I did pay a fee for that one credit card, but now I don't. Okay, make sure you know about any transaction fees, late fees, over limit fees, right? Read through what those fees are to make sure you can avoid them. And then other benefits like car insurance, rental car insurance. You can get discounts at certain stores if you have certain cards or rebates. Okay, product protection, warranty plans. There's a whole range of benefits that you can get from credit cards. So scout them out, see what they look like. Make sure you know what they are, because if you're going to use the card, you may as well also take advantage of the other benefits that it might offer. I talked earlier about convenience card users versus revolving credit card users. And this chart from the 2013 study shows how people use their credit cards. That large spike at 0, those are the convenience users. So this shows that about 30% of people pay off their credit cards every single month. And then there's another spike out at 100 plus months. That means that about 15% of people never ever pay off their credit card. They carry a balance more or less permanently. And you can see there's almost no lines in between, right? Almost nobody in between 0 and the max. That means that most everyone is paying off their card every month or keeping a permanent balance, and very little in between. There are some people, you can see there's some close to 0 there, some bars there. So there are people using their credit cards for a few months, help them with some short-term things, like the water heater example from the previous lecture. There are some people doing that, but by and large, people are paying it off or keeping it permanently, and not a lot of in between. Well, the FICO score is used so widely because it is effective, and this chart shows you that. So this is the percentage of people who are making the minimum payment or are missing their minimum payments by credit score. And so you can see all the way on the far left, the people with the lowest credit scores are the ones who are most likely to miss their payments. And then that line decreasing as you go to the right, as credit scores improve, shows you that the FICO score works. It is an effective way of predicting whether or not a borrower will repay their loans. And so if you are in this low range, you're in the 500s or the 400s even, and you're like, this is just wrong, this is not representing me, you're going to have to prove that to the lenders. You're going to have to prove that to the banks because they know the FICO score generally works. So you're going to have to prove that you're the exception. And as you do that, your credit score will start to rise. Now, I talked a little bit about credit card rewards earlier. This shows you who is making money for the credit card companies. Okay? So these charts are from the perspective of the credit card company. And so this top left chart, finance charge income, that's basically interest earned. Who is paying interest on their credit cards? And you can see that people with lower credit scores are paying interest, and people with high credit scores are not paying interest. Who's paying fees? The top right chart. Again, people with low credit scores are paying fees and they're paying interest. This bottom left chart, net charge-offs. A charge-off from a credit card company's perspective is when they just give up. Like, this person's never going to pay us off. Let's just call it a loss and move on. You see how straight that line is? How that decreases very consistently as the FICO score goes up? That's pretty strong evidence that the FICO score is effective at predicting how likely a person is to fail to repay their debt. And this bottom right one, interchange income, rewards expense. Rewards expense, that's the credit card company's expense. So the credit card company's reward expense is you, the credit card users, credit card rewards. Okay, so who is earning credit card rewards? you can see it's the people with high credit scores. So it's clear from these charts that there's a good way and a bad way to use credit cards. And not making the payment or keeping a balance for a long time causes you to incur finance charges and fees and causes you to miss out on the rewards expense. So if you're careful with it, you can earn lots of rewards expenses like I did with my airline credit card without ever having paid a finance charge. Right? I have never paid any finance charge or fees on my credit cards, but I've earned lots of rewards on them. And that's just a matter of paying them off every single month and then checking the reward program and finding one that fits my spending pattern. You fly lots, it may be worth your while to get an airline credit card. If you spend lots of money on Amazon, it might be worth getting an Amazon credit card. Look through the programs, look what they reward most for spending, and pick one that is consistent with what you usually spend your money on so that you can get the most reward that you can get from the credit card. Okay, just a few words about student loans now. I get people all the time asking me, what should I do about my student loans? How should I handle this? I'm having trouble with my student loans. What should I do? Now, there are a few ways you can negotiate the payment of your Stafford loan. The standard repayment plan, if you don't go in and tell them you want to change, is equal payments for 10 years. That's the standard. That's the default. If you don't make any changes, that's what you'll get. Graduated payment plans is where your payments increase over time at a regular rate. So you'll know, okay, this year my payment's $100 a month, and next year it'll be $110, the year after that it'll be $120. You'll know exactly what it will be in each year. Income-based repayments is where your payment is based on a percentage of your gross income. So if you're not making as much money as you expected, they'll reduce your student loan payment so it can be more affordable for you. The last option is extended repayment. You can lengthen out the term for up to 25 years. That will make your payment smaller, but you'll pay more in interest. That could be a good idea. It could be a bad idea. It depends on what you do with the money that you've freed up.